Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk, and today we're going to have a little bit shorter meeting, but we're going to talk about the CTI, the Cyclical Trend Index. We've had a lot of questions coming in over the last week or two since we started to put the calls into the market letter, and what we're going to do is we're going to talk about 20 or 25 minutes over that. We're going to talk about when adjustments are made to the CTI, what else we look at besides the CTI when we make a call, whether on a long or an avoid on the broader market. Then we'll open up the questions at the end. I imagine we'll have quite a few today, so I'll try to keep my part of it a little bit short. Okay, first of all, just to discuss the overall market. Okay, after last week, we've had a fifth straight week of gains. The Dow Jones, S&P 500 made it back into positive ground for the year. Just barely, I think, for the S&P, but we're back there. Dow Jones Transportation Index last week cleared its 200-day moving average. It's been outperforming, but has now rallied about 25% from its low, which actually occurred in on January 20th, around 6,400. So it's getting a little, although it's outperforming, it is getting a little bit stretched here. Like the other indexes, it's overbought. It's retraced almost a complete move from the November highs. And look at the different indexes. Most of them are all in a very bullish trend right now. We are seeing internal breadth numbers improving, especially on the NYSE AD line. That thing's almost up to its all-time high, which is a positive. And we're also seeing the new 52-week highs. Once again, on the NYSE anyway, hitting triple digits. Not robust by any means, but showing improvement. The NASDAQ AD line and new 52-week highs versus new lows continues to lag. That's a little bit bothersome, but not enough to get too excited about. Anyway, we've had several central banks around the globe over the last 2 weeks do their best to prop up stock prices, including the European Central Bank. Mario Draghi there cut rates further into negative territory, and they've also boosted their bond buying purchases. Our Federal Reserve last week chose to stand pat on rates, and they also cut the trajectory for future rate hikes going out to about 2018. That pretty much rang the bell for traders to go risk on at this point, but those buy signals are coming after quite a move off of the lows. I think the Dow's up probably around 13% or so off of the February low. So we are overbought. Something interesting yesterday, the Fed president, I think Dennis Lockard from Atlanta, actually came out yesterday afternoon and said that an April rate hike is not off the table. They could still consider that, and the market didn't even move. I thought that was kind of an interesting reaction to that, because certainly in the past we get these, anybody who brings up something about a rate hike, the market usually sells off. But anyway, what we're going to do, because I've been publishing that the CTI, which is basically the Cyclical Trend Index, is composed of 5 different cycles that we look at. And what we're going to do is it's actually going to a sell supposedly this week, but I can extend that going forward, and we'll take a look to see what would make me extend that. But before we go to that, I want you to take a look at this chart. This is the 8th year of the presidential cycle, which we're coming to. We've had, since 1902, we've had 6 presidential cycles. 5 of the last 6 presidential cycles that made it to 8 years have been down, and also have been down quite significantly. Very different from the 4th year presidential cycle, which almost always is up, usually around, I think it averages about 8%. But since 1920, the Dow Jones S&P 500 have suffered declines of 13.9% on the 8th year of the presidential cycle for the Dow, and 10.9% for the S&P 500. If you look at this chart, we're right about here on this chart as far as where we are in the year, and this is where we're about ready to go to a to the sell and on the CTI. So it looks it's kind of intriguing to look at that we may actually have gotten this big rush we have in the past over this time period, and maybe now we're getting ready to roll over. Okay, but anyway, this is something you want to compare. I think one of the reasons for this is because you come out and usually you're going to have a change of party after the 8th year, and so there's some hesitation, and people don't know what's going to be coming up with the next party, what their policy is going to be. But first, we're going to take a look at the CTI going back just to a couple of years here, because it was back through about 2008 to about 2010 to 2012. It really wasn't working very well. That was part of that is because the CTI is part of it is based on the 4-year business cycle, and when you go to 0 interest rates, you basically eliminate a normal business cycle where you have slowdowns and pick up in inflation and things. Oops, what happened here? Okay, until this thing pops back up here, I'll keep going. But anyway, the CTI has been we've been using that since 1974. It's outperformed the Dow Jones about 2 to 1. I hope you can still hear me. Can you? Like apparently the internet went down here, I guess. Look at your deck. Okay, well, I'm going to hopefully you can still hear me. But since 1974, the CTI has outperformed the Dow about 2 to 1. Again, like I say, we went out of sync after the Federal Reserve dropped the rates to 0%. Oh, here we go. Okay. Yeah, I guess we're back up. But anyway, I wanted to go over some of the calls since we started to come back in. The first one back here, we're going to start back in July of 2013. I didn't have a very good marker on this chart, but these red lines indicate where we went to a buy or sell. So first off, we're going to start back here at a buy on the weekend in July 15th, where we came in at 15,135. The CTI stayed at a buy, went to a sell up here at 16,469, picked up about 1,300 points over that time period. Okay, the sell came down to here, picked up about 300 points in the Dow. Again, we went to a buy going out here from 620 when it was a 16,947, and went to a sell again on 620 at 16,947, picked up 792 points. Over here, we went to another sell. Around here, picked up 848 points. Went to another buy on let's see. On January 16th, 15th, 2015, we went to a sell. That's over here at 17,511. Went to a buy February 13th, 2015 at 18,019. We actually lost 500 points on that one. Another sell April 15. Went to and that stayed as a buy over here until the weekend in September 4th. Now the reason that when something happens like this, we actually would have gone to a buy over in here. However, when some of the rules for changing, extending and adjusting the CTI, when we're going to a buy, we delay it if the Dow Jones has made a lower low during than the previous week. As long as it stays above the previous week's high, then we can rotate it back over to a buy. But as long as it keeps making new lows, we can extend the period out. So that's just some of the calls that we've made. I'll see if I can get a little better chart on this put up a little bit later. But just to take a look at the different cycles that we use. It's comprised of 5 different cycles of various lengths that are harmonious, and they'll bottom or top out pretty much at the same time. We call this amplitude, and we see these waves repeated in different rallies and corrections in the market. Okay, these cosine waves, however, aren't constant. I had some questions that said, when do you switch every 6 weeks or 18 weeks? What do we do? They aren't constant. Adjustments have to be made. The first cycle that we look at, cycle wave, the shortest term is 6 weeks. However, the adjustment period for that can be an extra 1 or 2 weeks. The second one, as you'll know, these are all multiplication numbers of each other. The second week, cycle B, is an 18-week period with adjustments that can be made adding at least 2 weeks either way, shorter or longer. Cycle C at 36 weeks, we can adjust that higher or lower by about 4 weeks. And we get over here, a longer circle, cycle D is at 72 weeks. That can be adjusted up or down 7 or 8 weeks. And then cycle E, you can see, is almost 4 years. Should we look at that? 4 years is actually about 208 weeks. So the cycle E is 216 weeks, and we can increase or decrease that by about 20 weeks. Okay, so the 4 years of the 200 cycle E, again, it plays into the 4-year business cycle where you start, with the economy starts out as struggling and things pick up, gets overheated, interest rates begin to rise to cool off inflation, and then we get some growth, and then a slowdown begins, and rates will, start to fall, and then things pick up again. It's just an ongoing cycle that has been going on for years. Because now also when you look at these different cycles in here, as far as you have what you call right and left translations, which means if the cycle comes out, it peaks over here at, say, 4 weeks and then comes down. And sometimes you're looking for the next cycle to begin on the left translation and start coming earlier. So there's a lot of different things we look at besides just marking off the time periods. Okay, what we also will look at during these cycles is something that if you read the market letter on Friday, it comes out Friday after the close. It includes at the bottom of the market letter a momentum index and a sentiment index, which included to help us determine whether to delay a projected signal. And the way that works is if we're going to go to a sell, but we have positive momentum up here. Here's the momentum index. Last week it was a 4. It was down 2 points from the prior week, and it was actually down 2 points or 4 points from the week before. So even though the market's still moving up, we are losing a little bit of momentum. But the reason we follow this, if this was going the other way, say going from a 4 to a 6 to maybe a 10, that would tell us that we don't want to step in front of a moving freight train and go to a sell signal, because you want to make sure that the market, that we can see some momentum beginning to roll over. So the momentum index and sentiment index are updated each week in the market letter at the bottom of the page. What we're looking at down here is what moves in numbers. If we get a reading of -4 or lower, it indicates the majority of the broader-based market indexes are weaker than the Dow Jones on a percentage basis. Readings of +4 and higher, and it can get up to about +12, +13, I think. That indicates that the broader market indexes are outperforming the Dow, and that the current market advance is wide basis across the board, and that's generally a positive thing. You want to see you don't want to see just the generals marching alone. In fact, they have an old Wall Street phrase that says, "When the generals march alone, you better be a little cautious." What that means is the Dow Jones is just marching ahead, but the other indexes, maybe the Russell 2000 and the NASDAQ and all, are not participating with that move. That's generally what you might see at a turning point in the broader market. Okay, we'll also look at internal breadth numbers. Over here, look at the trader's trend. We look at the new 52-week highs versus new 52-week lows. It takes into consideration the AD lines on the NYSE and the NASDAQ. We also look at the Marty Zweig breadth indicators, some of the McClellan oscillators that show accumulation and distribution, but also show just some of will give us some overbought and oversold readings that we want to look at also. Okay, then the sentiment index comes into play. This measures the market's bullish or bearish sentiment, And that's important when attempting to determine the market's future direction. We look at 9 indicators down here that are going to measure excess of speculation in the market. Also, just excess of sentiment readings, as far as everyone's bullish. That's kind of a can signal a top in the market. Everyone's overly bearish. That can signal that we're probably at a point where we want to consider selling off here. Okay, so what do you do when we go to a buy or a sell on the CTI? In this case, since we're going to a sell, what you can do is you can choose to start to lighten up on margin. If we went to buy, if you picked up on margin, you also want to be starting to take defensive positions, looking at where you want to get out of a stock if it starts to pull back. Another favorite thing that we like to do is look at inverse ETFs so that we can hedge our portfolio to the downside. Perhaps maybe you don't want to go out and sell your portfolio. However, if you buy some inverse ETFs, you'll make money on the way down. Another thing you could do is sell some covered calls on positions that you don't really want to sell. And what this actually does is you won't be in the market all the time. And when we go to a sell, as it works out, you may be out of the market, or at least in these inverse ETFs, for maybe 2 or 3 months. Again, instead of just riding the market up and down like so many people do, you're on the sidelines during the weak periods, and you're coming back into the market when things are picking up. Okay, so just to wrap this up, and I'm going to open it up to some questions, so you can start typing those out now. We are projected at this point to go to a sell on Friday. Part of that reason it's encouraging is even though the market's going up every day, the momentum index has fallen 6 points over the last 2 weeks. If I do see a pickup in the momentum index this week, I may extend it. You'll have to find out Friday after the close which one we're going to do. But unlike a buy where where I said as long as the market keeps making a new low, you can extend that out for 10 weeks if it keeps marching lower. A sell signal is imminent, and we try not to delay that more than a week or so. It's just the way the model works. So read the market letter on Friday when it comes out around 5 o'clock, and that'll let you know whether we're going to go to the sell. And you can find some of these inverse ETFs if you go into the ETF Center on the Market Edge site. We have the leveraged equity things. You might, instead of just buying the leveraged ETF on the Dow to the downside, I sometimes will buy a Russell 2000 and a NASDAQ and a SPY inverse ETF, and that gives me exposure because sometimes you'll see the smaller caps really get hit on a market pullback or something like that. So that's going to wrap it up for today. I'm going to go ahead and close this down so we can open up the charts and look at some questions. See if we got anything in here right now. Let me put this at the screen so we can share the charts. Okay, we're ready on this end. All right, questions. We got one over here. Okay, if the market's closed for Good Friday, will the weekly report come out on Thursday? Yes, it will. My bad. I forgot we were closed on Friday. So we'll take a look at this on Thursday. You'll see it coming out. It usually is on the website by about 5 o'clock. In this case, on Thursday. Anyway, somebody else typing a message in here. Okay, if you extend out the buy signal, which cycle is it for? It actually, right now, cycle A, B, and D are actually all bearish. Cycle C, or no, A, B, and D are bullish. Cycle C and E are bearish. So what we would do is we would extend out probably A and B. D is not going to be, won't need to be extended. And what we do is we also assign number values on these things depending on where they are in the cycle. If it's if we're on the 18-week cycle, if we're at number 16, that might represent a minus 10. Whereas if we're in week 6 of the 18th week cycle, it might be a positive 6. Then we add those numbers to determine how strong or weak the buy signal is at this point. Okay, I see somebody else is typing. Okay, if my ETF holding has an opinion as long and the CTI sells, which we listen to? Okay, that's a good question, because understand that the second opinion is a trend following market, a trend following model, and what that's going to do when the conditions are positive and they remain in place, they're going to keep you in a position. When the market's going sideways, sometimes you may get a little bit of whipsaw on the second opinion, because when it gets up to the top, it starts to trend, it rolls over and goes back because it stays in the range. However, the CTI is actually a forecasting model, and that's why you may have a long on the SPY or the IWM or whatever, and we go to a sell on the CTI. That can happen, and the reason is because we're forecasting that the market's going to roll over here. Okay, why are inverse ETFs weak? The reason they're weak is because you've had 5 straight weeks of the market moving higher. So that goes where you want to buy low and sell high. So the inverse ETF should be very low. You get a good price on them right now. If we go sideways to down, and this thing doesn't have to go down 500 points to make it a great call. If it goes sideways and you're for the next 6 weeks, and right now I think this thing is supposed to stay out on a sell until the end of May. You're exposing yourself less and less time to the market. So it's good that the inverse ETFs are weak. You don't want to be chasing those higher as we go to the sell. So we are stepping in front of the train a little bit. We want to see how the momentum in the RSI maybe show some negative divergence, and we'll see what happens to that. Okay, which have we had the most success, CTI or second opinion? Quite frankly, I would have to say that I think the CTI has done a little bit better. I know in 2015 we had the Dow was down about 2.25%. Where if you'd have gone long and short, just not on an inverse fund, but if you'd have gone long and short trading the CTI, you were up about 18%. I think this year, right now, you're flat on the Dow Jones. I think this year we are up about, I'm guessing, I think we're up about 10 to 12% going long and short on the CTI. I have another one coming in. I think they stopped typing. Okay. Would you recommend taking action to sell immediately after the CTI changes to sell? I think that what you do is you look at the market and you start to see this as okay, well, I can take a small position when you're going into something that looks like the market still looks strong. Maybe you take a smaller position, and like this last buy signal, we've made several hundred points on the Dow Jones, but we were down 300 points after the call was made. So the market bottomed 2 weeks after we went to the buy. But we're in there now, and we've held you in the market that way. So it may the market may not turn for another week or two. So you may want to let you take a position, and you can always add to the position when it looks if things start to get momentum to the downside. But which it's not cut and dried where okay, well, the market's going down from here. And the calls can be wrong. Out of the last 1, 2, 3, 4, 5, 6, 7, 8, 9, out of the last 10 calls we've had, we lost money only on one, and we had another one that was flat, and another one that was just up a little bit. So this isn't an exact science, but it's something like I said that's going back to 1974 has worked extremely well and basically outperformed the Dow almost 2 to 1. If you did not short CTI and just went to cash, is the performance about the same as second opinion? Not sure. The second opinion is going to probably be more in line with what the broader market's going to do. I think when we back tested where you came out of the market with -3 or -4, you end up beating the market by 1 or 2%. InvestStars for Fidelity a couple years ago, they actually they did the let's see, on the S&P 500 for the period ending on for 1 year. This was done in they wrapped it up in January 15. But for the 1 year period trading the S&P 500, the S&P 500 was up. My glasses here. It was up 12.84%. We were up trading it with the second opinion. You were up 17.7%. Going out over 2 years, the S&P was up 38%. Using the second opinion, you were up 50%. And then going out over 5 years with the S&P 500, it was up 88% versus 124% for the for second opinion. That was done by InvestStars for Fidelity. That's the latest thing we have as far as our rankings go. And as far as going to cash when you go to CTI, again, it's something where this is not an exact science. If I was on margin, I certainly would start coming off of margin. Maybe if you have some of these oil stocks or whatever that have gone from $5 to $15, maybe you lock in your profit, buy a 50-cent put on something like that. So if the market rolls over and oil starts heading back to $30, you've locked in your profit, and you're risking 75 cents or something like that to lock in that profit. When you have these moves like that, that's one way to play it. Here, buy and sell signals for different cycles. Say the longer cycles more significant than for other cycles. Yeah, they are, because again, when you get for the cycle E, once you get halfway through that cycle or more, you're basically calling for a down the flat market, because basically what you're thinking is the business cycle is slowing down, and you're probably that's the major trend for the market at that point should be down. Now these the cycle A, and especially cycle A, that's just a little that's something that's in there that's probably has less weight to that than any of the other ones. Cycle B is it has less weight than cycle C and going out that way. That's why what is it, C and E are in bearish cycles right now. So we think that we'll probably the market should probably come out somewhere. I think we're in cycle E. We're about 177, week 177. So you're looking at another 30, 40 weeks maybe till that thing bottoms, which would coincide with a market bottom to this beginning a new bull market probably sometime the end of the year, first of the year. Can you tell us what week of cycle E we're in? Yeah, as I just said, I believe we're in cycle 177, somewhere in that category. I should have written that down before I came in here, but that's kind of where we are on the big one. So I think we got about another 30 weeks. That when you looked at that first chart where the market bottoms, in the 8th year of the presidential cycle, it kind of works out pretty conveniently for that. Okay, that's our 30 minutes. If you have more questions on this, please feel free to send me something at the doc at marketedge.com, and I'll try to go into more detail. I hope that helps you out, because the CTI is a pretty valuable tool. It's worked out well, and I think that just keeping that in your arsenal, it can help you lighten up on some positions and not get blindsided by a weak period of the market. And also, if you are on the sidelines or you've lightened up on positions, you're not going to ride these markets up, these swings up and down. And if you're not riding them down, hopefully you'll keep more money in your portfolio. And I hope that you benefited from this. And we'll talk to you next week. Thanks for joining me.